Welcome to ZICA Academy YouTube channel. In this lecture, I want to solve question on ICAN November 2023 performance management question number 5 on credit control analysis and investment analysis. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. Example: Vena PLC manufactures engineering equipment. The company has received an order from a new customer for 5 machines at 5 million naira each. Vena PLC's terms of sale are 10% of the sales value payable with order. The deposit has been received from the new customer. The balance is payable 12 months after acceptance of the order by Vena PLC. Vena PLC past experience has been that only 60% of similar customers pay within 12 months. Customers who do not pay within 12 months are referred to a debt collection agency to pursue the debt. The agency has in the past had a 50% success rate of obtaining immediate payment once they became involved. When they are unsuccessful, the debt is written off by Vena PLC. The agency fee is 5 million naira, 500,000 naira per order payable by Vena PLC with the request for service. This fee is not refundable if the debt is not recovered. You are an accountant in Vena PLC Credit Control Department, and based on the company's past experience and on discussions with the sales and credit managers, you do not expect the pattern of payment and collection to change. Incremental costs associated with the new customer's order are expected to be 3.6 million naira per machine. 70% of these costs are for materials and are incurred shortly after the order has been accepted. The remaining 30% is for all other costs, which you can assume are paid shortly before delivery. That is in 12 months. That is in 12 months' time. The company is not presently operating at full production capacity. A credit bureau has offered to provide an error-free credit information about the new customer if the price is right. Vena PLC opportunity cost of capital is 16%. Ignore taxation. Required. Write a report to the credit control manager which evaluate from a purely financial point of view whether Vena PLC should accept the order from the new customer on the basis of the above information. B. Comment on what other factors should be considered before a decision to grant credit is taken. This question is obtained from ICAN November 2023 performance management question number 5. Now, let's have the solution to the question. Solution. Now, let's have this calculation as an appendix to the report. Appendix to the report. So, you want to calculate, you have to evaluate from purely financial point of view whether Vena PLC should accept the order from the new customer on the basis of the above information. If you look at the information provided in the question, there are information that will enable you to analyze the cash flows. Then you are also given the cost of capital of the entity. Since the cost of capital is provided, that means you want to calculate the present value or the net present value. Now let's go back to the question. Vena PLC The name of the entity is Vena PLC. Let me put it here. Vena PLC. Manufactures engineering equipment. The company has received an order from a new customer for 5 machines at 5 million each. 5 machines, 5 times 5 million. Since one machine is 5 million. That's because of the word each. So 5 times 5 million, that will be 25 million. Vena PLC terms of sale are 10% of the sales value payable with order. The payments are made with order upon placing an order for the goods. That is, when customer places an order for the goods, then they'll be asked to pay 10% of the sales value. That means 10% of 5 times 5 million, that is 25 million. 10% of 25 million, that will be 2.5 million. 2.5 million naira is expected to be paid with the order. The deposit has been received from the new customer. The balance is payable 12 months after acceptance of the order. So if the initial payment of 2.5 million are made, remember the total value is 25 million. Then the remaining 22.5 million, if you subtract 2.5 million from 25 million, you'll be left with 22.5 million. The remaining 22.5 million will be paid in 12 months after. That is a year after. After the acceptance of the order by Vena PLC. Vena PLC past experience has been that only 60% of the customers pay within 12 months. So 60% normally pay within 12 months. So customers who do not pay within 12 months are referred to a debt collection agency. That means you are having then 60% will paid within 12 months. Okay, back to the question. Customers who do not pay within 12 months are referred to a debt collection agency to pursue the debt. The agency has in the past had a 50% success rate. Now, those who did not pay within 12 months, the remaining that will be 40%. If you subtract 60% from 100%, you are left with 40%. Then the 40% will be referred to debt collection agency. And you were told the chances the agency has in the past had a 50% success rate, 50% success rate, 50% success rate, 50% of the remaining balance, which will be referred to agency. That will be 20% success rate. Unsuccessful now, or failure rate. That will also be 50%. Oh, let's go back to the question. 50% success rate of obtaining immediate payment once they became involved. When they are unsuccessful, the debt is written off by Vena PLC. So if it is unsuccessful, it will be written off. That means it becomes a bad debt. The agency fee is 5 million. The agent will charge 500,000 rather. So the failure rate now, if success rate is 50%, failure rate will be 50% of 40%. That will also give us 20%. That means the success rate is 20%, while failure will also be 20%. That means we have 3 possible outcomes. We have 3 possible outcomes. Let me have 3. Outcome 3, outcome 2, outcome 1. They have the amount in 1,000 naira. Then we are given the cash flows. Cash flows. Back to the question. Vena PLC manufactures engineering equipment. The company has received an order from a new customer for 5 machines at 5 million each. So 5 machines will be bought at 5 million each. Vena PLC terms of sale are 10% of the sales value payable with order. Now let's have the cash flows. Cash flows. Payable with order means payable now. That is those one that will be paid immediately. So you were told 10%. Vena PLC terms of sale are 10% of the sales value payable with order. The sales value is 5 times 5 million, which is 25 million. 10% is payable with order. So now we have receipts. That one is a receipt. 10% of 5 machines times 5 million naira. No, 5 times 5 million, that will be 25 million. 10% of 25 million, that will be 2.5 million. 2.5 million will be received immediately. Back to the question. The deposit has been received from the new customer. The balance is payable 12 months after acceptance of the order by Vena PLC. Now, what will be the balance? Now, after the acceptance of order, back to the question, when will the order be accepted? 12 months after, which is a year's time. So, we have year 1 cash flows. The balance now. No, if 10% is paid immediately, then you'll be left with 90% times 5. That gives us 22.5 million. 22.5 million. That is in year 1. 22.5 million. We'll be having me here. I will explain the reason why you will not need to include the 22.5 million here. Back to the question. I want to explain that. Customers who do not pay within 12 months are referred to a debt collection agency to pursue the debt. The agency has in the past had a 50% success rate. There could be a success rate in the second scenario where I put 22.5 million of obtaining immediate payments. Once they became involved, when they are unsuccessful, that means this scenario 3 or the outcome 3 is when they are not successful. Nothing will be received here. That is why I put dash. For this one, certain amount will be received. Money will be received here. But this one, unsuccessful, which is failure. So nothing will be received. Everything here becomes bad debt. That means you have that cash flows to be nil. The agency fee is 500,000 naira per order payable by Vena PLC with the request for service. This fee is not refundable if the debt is not recovered. Agency fee of 500,000. So now let's have agency fee 500,000. In the first scenario, no agent is involved. No, it is these 2 cases that agents are involved. This one is when it will be successful. This is when it is not successful. So, agency fee of 500,000 will be paid here, irrespective of whether it is successful or not. And that fee is not refundable. You are an accountant in Vena PLC, Credit Control Department, and based on the company's past experience and on discussions with the sales and credit managers, you do not expect the pattern of payments and collection to change. Incremental costs associated with the new customer's order are expected to be 3.6 million per machine. Since it is per machine, remember 5 machines were acquired, so that means you have times 5. 3.6 million times 5. That gives us 18 million naira per machine. 70% of this cost are for materials and are incurred shortly after the order has been accepted. So that means this payment will be made after the order has been accepted. That is 70%. The remaining 30% is for all other costs which you can assume are paid shortly before delivery, that is in 12 months' time. 70% will be paid immediately, and you were told it is material. You were told they are material. Incremental costs associated with this. 70% of these costs are for materials. So, and they are paid and are incurred shortly after the order has been accepted. Back to the solution. So we have material cost, which is 70%, and the cost is 3.6 million times 3.6 million. The 3.6 million naira is per machine. For 5 machines times 5, that will be 18 million. 3.6 times 5, that will be 18 million. 70% of 18 million, that gives us 12.6 million. 12.6 million, that is an outflows. 12.6 million outflows. 12.6 million outflows. Then you were now told, and the remaining 30%, is for all other costs which you can assume are paid shortly before delivery, that is in 12 months' time. The remaining 30% is any other cost, and they are payable in 12 months' time. So you have other costs, and you were told it's 30%. 30% of 3.6 million naira times 5 machines. 3.6 times 5 times 30%. That gives us 5.4 million. Outflows. Then back to the question. The company is not presently operating at full production capacity. A credit bureau has offered to provide an error-free credit information about the new customer if the price is right. Then opportunity cost of capital is 16%. Now, these are the cash flows information. Now, those ones will be payable in year 0, and those that will be payable in year 1. 2.5 million is a receipt minus 12.6 million. We have 10.1 million outflows. That is the net cash outflows. Then for second scenario, it will still be the same. The third one will still be the same. Then for cash flows in year 1, we have net cash inflows. Receipt is greater than payments. That is why we have it as an inflows. 22.5 minus 5.4. We have 17.1 million. Then for this, we have 16.6 million. Then for this, we have 5.9 million. This is negative. This is positive. This is positive. What is discount factor? You are given cost of capital to be 16%. Vena PSC opportunity cost of capital is 16%. Ignore taxation. So the cost of capital is 16%. Remember, to calculate the discount factor, 1 plus R raised to power minus N. If R is 16%, which is 1.16, 1.16 raised to power minus N. N is 1. Raised to power minus 1. That gives us 0.862. This is not year 2. This is not, everything here is for year 1. Year 1 cash flows. Only that you have them in different possible outcomes. So what is the present value of our cash flows? The present value, let's multiply 17,100 times 0.862. We have 14,740. Year 2, 16,600, second scenario rather, 16,600 times 0.862. That gives us 14,309. The third scenario, you have 5,900 times 0.862. That gives us 5,086 negative. Now, what is our cash outflows in year 0? Cash outflows. These cash outflows for year 0. That is those ones that were payable immediately. And you have that to be 10.1 for each of the possible outcomes. 10.1, 10.1, 10.1. So if you subtract, this will be left with 640, 4,640. That is net present value. 4,640. Let's subtract this. This is 4,209. 4,209. This will be 15,000 negative because this is negative and this is negative. 15,186. 15,186 negative. Vena PSC past experience has been that only 60% of similar customers pay within 12 months. Those that pay within 12 months, that is 60%. So now, let's have the probability. Those that pays within 12 months, that is 60%. Back to the question. Customers who do not pay within 12 months are referred to a debt collection agency to pursue the debts. The agency has in the past had a 50% success rate of obtaining immediate payment. The success rate is 50%. No, is 60% paid within 12 months. You'll be left with the balance of 40%. That is 100 minus 60%. That is what gave me 40%. 50% of 40%, that is 20%. The same thing happens here. The remaining 20% will be this. 20 plus 20, 40. Plus 60, that is 100. What is the expected net present value? Expected net present value. You multiply the net present value by the probability. 4,640 times 0.6, that gives us 2,784. 2,784. 4,209 times 0.2, that is 20% probability. That gives me 842. 842 naira. The third one, 15,186 times 0.2. That gives us 3,037. Negative. 3,037. Negative. So you now sum up everything. Let's add them. 2,784 plus 842 minus 3,037. So we have 589. That is the total. 589. That is this plus this minus this. Remember, this is negative. This plus this minus this gives us this. This is positive. So that means the order is financially viable. It is a viable order. So now that is the appendix. Now we want to write the report. But to write a report to the credit control managers. We want to write reports to a credit control manager. They have the report. This report goes to credit control manager. Who are you in that organization? You are the finance manager. You were told somewhere in the question. From the finance manager. Then date. And put today's date. 6th November 2024. Then subject. What are you asked to do? Back to the requirement A. You are to evaluate from a purely financial point of view whether the vendor PSA should accept the order. Now let's have order from new customer as our subject. Order from new customer. Having examined the information provided, I have come up with 3 possible outcomes, which were analyzed in the computation of the expected net present value. The attached appendix is relevant to this report. Since the result obtained from our analysis shows the positive expected net present value of 589,000. It can be said, therefore, that the order is financially viable. See the appendix. So, the B part of the question, B, back to the question. So, in the B part of the question, you are to comment on what other factors should be considered before a decision to grant credit is taken. So that is the B part of the question. But I won't be able to provide solution to the B part of the question because I don't want the video to be too long. So I will advise you go back to the Pathfinder to the solution to the B part of the question. So please drop the love emoji. Also share the video with others. Thanks for watching ZICA.